everyone, it's Friday and you're watching Within the Frame. I'm Kim Bo-kyung. Quite recently, the International Monetary Fund announced that it kept its GDP growth forecast for the global economy steady at 3%, but lowered its expectation for next year by 0.1 percentage points to 2.9%. This due to a faltering Chinese economy and a sluggish manufacturing sector. For South Korea's, the organization maintained this year's growth outlook at 1.4%, but revised down next year's forecast. What are the reasons behind this, and how do experts see the current global economy? For more on this, we have invited Professor Sung-soo Eric Kim from UNIST School of Business Administration. He is also the founder and CEO of Datacrunch Global. Professor Eric, welcome.
Thank you for having me.
Thank you for being with us. And we also have Professor Hwagyun Kim from Texas A&M University's Mays Business School. Professor Kim, welcome.
Thank you for the invite.
Thank you. Now, Professor Eric, first question. So recently, the IMF maintained this year's global growth rate at 3%, but cut next year's outlook to 2.9%. Why is this so?
We have speculations that the economy is recovering, but at the same time, we are foreseeing macroeconomic risk. At least we can point out 4 risks that are consistently becoming a bottleneck to the economic growth of the world. First, the Ukraine and Russia war situation is continuing, which the energy price and other macroeconomic situations are impacted by the situation. And we have a developing war between Israel and Palestine, which will have an impact on the oil price primarily, and which we cannot really predict how the situation will evolve. We also have a continued inflation in U.S. economy, which we expect that the Fed will not decrease the interest rate in short term. So this is becoming a global uncertainty that we expect that the global economy will not see a significant growth next year. And finally, the Chinese economy is slowing down. So this is becoming a major influence to the global economy, since the Chinese economy used to be, it traditionally is the strongest buying power. It's the economy with the strongest buying power. So I could summarize that these are the macroeconomic risk factors that the IMF is concluding on.
All right. Well, among many reasons Professor Eric mentioned was faltering Chinese economy, Professor Kim. As far as I know, China's GDP growth in the third quarter of this year exceeded economists' forecasts, reaching 4.9% on year. Is this not enough to change the outlook?
Well, first of all, including IMF, lots of forecasting models are different, and IMF uses different model, and so it's not always easy to forecast accurately. And also, I just looked at the IMF's outlook, the documents, and then they use the data up to 2022. So it's not super updated data. So in some sense, there could be some lags in forecasting. Having said that, I just also looked at the IMF's outlook about China, and then they think that the IMF thinks that the recent the recovery mainly comes from the retail sector and also service sector, while they're still grappling with the real estate tech sector and the related financial sector, which actually has more the bigger impact, more and bigger impact, and also the issue, I think, is going to be more long term. So clearly, they think that this is more important than the recent recovery. So that, I think, is impacting that.
Right, I see your point. Now, Professor Eric, as you have already mentioned earlier, inflation is one of the most important factors that determine global growth projection. And the IMF said the global inflation is forecast to decline steadily, while core inflation might take a little bit longer to come down, perhaps until 2025. Why is this?
So we have to understand that monetary policy takes time. So although the central banks play around interest rates to aim to control the economic situations, it takes about a year to 2 year lag effect on when the actual policy takes into place in the economy. So we need a little bit more time for the for policies for Fed to be effective in the market. And also we have to understand that during COVID, not only Fed but all central banks have poured in historical amount of money supply to the market, which the market still needs time to digest. And additionally, the war situation in Israel and Palestine is developing, and also OPEC is agreeing on reducing the supply of oil, which we expect that the oil price will rise, which will cause a fundamental influence to the inflation. And that's why the Fed is pessimistic of the inflation situation being controlled at current stage of the U.S. economy.
All right, so we'll have to wait for 1 or 2 years to see core inflation being maintained and being contained.
I would say not from now, but from the point that the central government starts to deploy such policies, we should see at least about a year period or longest 2 year of lag periods to see it being effective.
All right, I see. Now, Professor Kim, let's also talk about geopolitical issues as well. The situation is getting serious in the Middle East region with the possibility of Iran becoming involved in the Israel-Hamas conflict. If Iran does, it is highly likely that, as our Professor Eric already mentioned, oil prices will surge, and this would inevitably affect inflation as well. To what extent might this happen?
Well, obviously, if the Iran really is deeply involved with this the conflict of the Israel-Hamas, then clearly this becomes like a structural break in terms of like the inflation and also the oil price and the monetary policy. So we have to check how likely Iran is going to be really involved, and the war situation is getting aggravated. But having said that, basically, if the oil price goes up because of this, then at the same time, the U.S. and other oil exporting countries start thinking, if this continues, then this is going to be a big problem. So they'll probably try to increase the supply, at least by some deviating countries. And then I think the monetary policy probably try to just to curb the inflationary pressure by increasing the interest rate, or at least to maintaining the high interest rate. So it is going to be very conflicting and uncertain period, at least for a year or something. So we have to see at least for the next quarter or something to see how this situation evolves to talk more about it.
All right, I see. We'll have to just wait and see how the situation develops. Now, Professor Eric, according to the IMF report, the U.S. is seeing a higher possibility of soft landing. But as the money flows to the safe haven dollar, it is said that other emerging markets, those low and middle income countries, are having a much more difficult time due to soaring import prices and debt increases. Is this really the case?
So generally speaking, if the U.S. interest is higher than the emerging economy's interest rates, then foreign direct investment will flow out of that country and withdraw because they can see a higher return on investment in the U.S. market. So that's the macroeconomic risk of the emerging economy. And also because of the strong dollars, the domestic market will slow down. So that's also a risk to emerging economy. And more importantly, because the U.S. economy is so strong, the business activities and they can expect trade deficits from the U.S. with the U.S. economy coming from the strong U.S. dollars. So the U.S. economy is recovering due to the monetary policy of Feds, but at the same time, because of the strong dollar, emerging markets will suffer at some point.
All right. So as far as I understood it correctly, the main reason is the Fed's prolonged monetary tightening policy, right? Well, that makes me wonder, as investors have increasingly priced in the likelihood that the Fed will lift the interest rates higher and longer than expected, 10-year Treasury yield went over 5%. What does this hint at?
So in general, the interest rate of bond is determined by a couple of factors, at least 3 factors. First, the price of the bond. The interest rate goes at the opposite direction of the price of the bond. And second, the risk premium, default risk of the bond. And third, for the case of U.S. Treasury bills, a long-term expected inflation will also determine the interest rates. We had a developing situation of the U.S. bond price going down because of mainly 2 factors. Because China is not buying that much of a U.S. bond, so the demand is shrinking. At the same time, U.S. Is cutting down the position of U.S. Treasury bills on their balance sheet. So that is also providing a supply to the market, which there was a oversupply of U.S. bonds and the price dropped, which caused the interest rate to go up. But the situation is a little bit different from just the monetary supply and demand, the bond supply and demand situation, because the Fed was conferring that the inflation situation might take longer than they expected. So this is driving up the expected interest rate, the expected inflation, which is causing the bond interest rate to go up. Plus, there is a minor influence of the threat of U.S. government's shutdown, which is causing a little bit of a default risk to the interest rate. So that's the reason why we're seeing a historical rise in the bond interest rates since 2007.
All right, I see your point. Now, let's also tap on South Korea's situation, Professor Kim. The IMF maintained this year's growth outlook for South Korea at 1.4%, the same as last July's forecast. But it slashed its growth projection for South Korea for 2024 to 2.2% from the earlier forecast of 2.4%. Why was it cut?
So I just read the IMF's briefing about this outlook about South Korea, and then it's somewhat related to, according to their assessment, the downturn in the technology exports, which is the main part of our, the exports, is projected to dampen in the near future, at least for a year or something, and that actually hampers the economic growth fully recovered for the next year. So that actually makes this kind of slightly going down. But I think the IMF also mentions that the economy is expected to rebound because global economy is getting better. So they seem to be more cautiously optimistic about that part. And then one more thing is they seem to add about this fiscal buffer. So clearly the Korean government starts decreasing the fiscal expenditure. And that actually can have like a negative impact on the GDP growth because the part of GDP comes from the fiscal expenditure as well. But in this case, actually, they think that it's a great move because fiscal buffer is important so that the government in Korea actually can respond to all kinds of other shocks given the uncertainty. So despite that it's slightly lower, it's not that bad, and it's probably healthy type of the lower projection, mostly coming from this technical issues of the export and also related to the fiscal expenditure reductions.
All right, I see. We will tap on all of the things our Professor Kim talked about. But before that, Professor Eric, the IMF has predicted that the Japanese economy is going to grow by 2% this year. And it is the first time in 25 years that South Korea is falling behind Japan regarding economic growth rates. First of all, why is this happening and how serious is this?
So on the surface, it's happening because Japan is maintaining a lower interest rate. Despite of the, global economic situation, they're being really courageous to take that action, and that's actually helping the Japanese economy to grow. At the same time, we're maintaining a higher interest rate, which is not helping our economy. And plus, we had an issue with the semiconductor and tech business on the export side. So that actually is contributing to our lower growth on the surface. But more fundamentally, we're going through a structural problem in our economy. Coming from at least 4 points. First, I think that we are experiencing a advanced economy disease too early. Coming from our workforce attitudes and productivity, I think we're too much, enjoying our lives, while we have to really focus on economic growth and push through the business situations. Firms are reluctant to do that, and also our labor forces changed to an advanced economy mindset. So that's very, very different from a couple of years ago, where we could drive economic growth with longer working hours and attitudes. So that's a fundamental change. The second thing is regulation. So there are still a lot of sectors, at least in the growing, technological industries, that we have to deregulate in order to foster the industry. So this is becoming a continuous issue for our economy. And the third thing is globalization. I would emphasize globalization, globalization, and globalization, because we have to understand that our market is too small. So the reason why we could grow dramatically over the 40 years or so was because we were exporting country. But if that engine slows down, then we immediately face a risk on our economy. Then how do we maintain that engine? We really have to get into the global mindsets. Our companies have to be born to be global, etc. And the last thing is probably real estate and debt. We have too much debt, household debt,
Right.
Which is caused by the expectation that the real estate price will go up and insecurity and real estate policies, etc.
All right, I see. Now, Professor Kim, you have already mentioned this, but I'd like to delve a little bit deeper. Finance Minister Chu Kyung-ho said the economy is entering a recovery phase, like you said before, based on some indicators, especially regarding semiconductor industry performance. Is it really?
Well, the answer is probably yes and no. It's mostly yes, but very recently, I think the U.S. starts blocking again, the export of these semiconductor chips to the China. So I think because of that, I think some of the U.S. and also the Korean semiconductor chip makers' stock prices just plummeted. So clearly, there are some new developments, and obviously, the the China trade tension is not over yet, and probably this is going to continue for the time being because it's kind of a tug of war, never sort of ending for the time being. So, in terms of an overall global recovery phase wise, yes, it is true that the semiconductor business now, I think, hit the bottom and starts going up. But then the big buyer, China, is probably going to be still somewhat weak because of these tensions and also the U.S. regulations. So we have to see.
All right, all right. Well, Professor Eric, even if our Professor Kim says the chip industry is seeing recovery, like he said, there are certain uncertainties. And adding on to that, there are still concerns over growth as well. And could that be the reason why the Bank of Korea, maintained its key interest rate recently?
So I think it's a very difficult situation because if you look at our inflation rate, which is 3.7%, and considering the interest rate gap between U.S. and ourselves, which is U.S. is 5.5% and we are 3.5%. So we are looking at a historical spread of 2%. We have to increase the interest rates, but at the same time, if you look at our household debt, we have about $830 billion of household debt, and our economy is also having a problem. So if we increase the interest rates, then we immediately get into a short-term economic risk. So we're really stuck in the situation that we cannot increase our interest rate, and neither we can reduce our interest rate. I've been publicly worrying this situation since 2022, and actually we're in that situation right now. Then what is the solution in these kind of situations? We have to really redesign our financial policies, commercial financial policies to help the economy, and also think about if there's any sectors that we can deregulate temporarily to boost up the economy. So that will be one of the solutions to get out of this situation.
All right, a piece of advice to think about. Well, Professor Kim, before we wrap up, there is another concern we need to address. South Korea's debt to GDP ratio is becoming increasingly serious, projected to approach almost 58% by 2028, putting the country second highest on the list of non-reserve currency nations. How serious is this?
Well, obviously, the reserve currency countries, clearly their debt to GDP ratio is over 100%. So clearly, it's very high. And of course, we're not currency. We don't have currency anchored for this type of things. But so this currently, as of now, it's around 53%. And if it goes up to 58 to 60%, clearly it's going to be a bit more burdensome, in part because the household debt is also pretty big. So in our case, because not because the number itself is high. Even if it's 58 or 60%, the number itself is not that big. However, because the household debt burden is very high, the combined debt of the country, both the private and the public, that can be a problem. So I think, at the same time, we have to reduce this, household debt. But at the same time, I think we have to think about, maintaining the public debt at the current level, or at least, the 58, 59 margin at the, max. So I think at this stage, it's not too serious as a threat. But if we don't decrease the private debt, household debt, that's potentially going to be a big issue.
Right, so we definitely need to take measures. We need to do something. And so, Professor, yes.
The overall debt is there, right.
Right. And so, Professor Eric, this is the reason why an IMF official said that it would be important to build so-called fiscal buffers so that debt does not become a major issue down the road. What should be done to avoid this scenario?
So that recommendation probably goes to all of the countries nowadays, because the central governments in all countries poured too much money into the market and was debt financing. But particularly for Korea, it's becoming a problem because we are seeing, tax revenue deficits, and that was due to our misforecasting of the revenue this year. We're working on revising our forecasting models. Of course, it's really, really hard to do accurate tax revenue forecasting during fluctuating economic situations. So that is the main reason why we missed forecasted tax revenue. And second, we are cutting down budgets on inefficient areas. So we're reevaluating our budget allocation. So mainly, we're trying to cut down budgets on duplicated allocated sectors. But we also are trying to promote more budgets on sectors that can really create a market economy with considerations on social redistribution. So that is the key focus of the government right now. On the private sector debt, this is one of my recommendations to the society and the government. We probably have to reevaluate how we do credit rating, because our current credit rating system makes the people that are in worse situations pay a higher interest rate, and it makes it really hard for them to get out of the situation. So there should be a redesign and social agreement of how we should protect such income groups that are at risk and help them to get out of that situation with a financial policy considerations.
All right. Thank you for your advice, Professor. Well, unfortunately, this is all the time we have for today's edition. Thank you, Professor Eric.
Thank you very much.
Thank you. And thank you, Professor Kim, for your time and insights as well. We really appreciate it.
My pleasure.
Thank you. All right, that's all for Within the Frame tonight. We'll be next Monday with more in-depth stories. Thank you for watching. Enjoy the weekend. Goodbye.